we are now going to talk about Chapter 9 in Personal Finance. This is all about health and disability income insurance. So we are mainly going to talk about health insurance during this. This is very useful information, and you can always let me know if you have questions after this lecture. So first we're going to talk about group health insurance. This is the most common form of health insurance. Usually you would get this through your employer. Hopefully the employer will pay a good portion of this cost, maybe even all of it. It's definitely a benefit that you want to consider when you are making a choice on which job to accept. So with group health insurance, it is a bunch of people going in on health insurance, and you're paying your premiums. Remember, just like home and auto insurance, that is the amount that you're going to pay on a monthly, or maybe it's biannual or annual, depending on which kind of insurance. Health insurance would typically be monthly. You are going to pay an amount to move your risk, that financial risk of what if something goes wrong? What if I have to go to the doctor? What if somebody breaks a bone? What if I have to go to the hospital or have a surgery? You are taking that financial risk and putting it at least partially on the insurance company. So you pay a premium, an amount every month in order for the insurance company to cover you. So with group health insurance, like I said, usually it'll be offered through an employer. Under group health insurance, you are covered until you are 26 years old under your parents. So if you are less than 26 years old, that might be some good news for you. And it varies a lot in how much protection you're getting. A lot of times employers will offer a couple, maybe even 3 different options for which plan works best for you and your family. Maybe it's a high deductible plan, so you don't really go to the doctor a lot. Maybe you don't have a lot of prescription medicines. You just want to have insurance in case something big happens. Then you might get one of the cheapest plans on a monthly basis. But if something goes wrong, you would have to pay more out of pocket before insurance would cover it. And we're going to get more into detail about that. But if you're somebody who is maybe older, or you have an illness, you have to take lots of medication, you might want to get a more expensive health insurance that is going to cover more, because you know you're really going to be using that health insurance a lot. You don't just have it for the big expenses. You have it there because you know that you're going to be using it several times throughout the year, and it's very important to have. If your employer does not offer health insurance, or maybe they don't offer enough, or something that you want to get in on, maybe it's too expensive, then you can go and get individual health insurance. This is not through your employer. That means you are paying 100% of the cost, which means that a lot of times it's going to be more expensive that way. But this is an option. There are employers, especially small companies, that do not offer health insurance. So this needs to be an option for people. They can go and get their own insurance. All right, here's a big fun phrase: Consolidated Omnibus Budget Reconciliation Act of 1986. Don't worry, I will not test you on that phrase. We're going to abbreviate it and call it COBRA. So COBRA is a temporary insurance that some people are allowed to get when you are in between maybe jobs, maybe you're going through a divorce, maybe you are no longer have the dependents that you had before. Whatever the situation may be, you may be offered this COBRA insurance, this temporary insurance to get you through this transition period. Typically, COBRA is quite expensive, but if you do not want to have a lapse, a time period where you do not have insurance, then this is definitely something to consider. There are lots of different kinds of health insurance coverage listed in the book, and it gives you details about it. I'm not going to cover all of those in this lecture. I'm going to cover some of the main ones that are going to pertain to the most people. So first we have major medical expense insurance. This is for those big things like hospital visits, surgeries, things like that, anything big that may happen. This could be for somebody who doesn't go to the doctor very often, but they just want insurance to cover anything major that might happen, because you don't want to find yourself in a situation to where you owe $100,000 because you got in some kind of accident, which does happen, unfortunately. The second you get admitted to a hospital, there's going to be thousands of dollars. I mean, it is very difficult to get out of the hospital without spending that much. My husband had a kidney stone recently, first one ever for anybody in our family. Had no idea what was going on. Very, very, very painful. If any of you have ever experienced that, then you know. And he was in the emergency room for just a couple of hours, and he had a CT scan. Did not stay overnight, but it was over $10,000. Now, insurance did pay like 70% of that, but still, that was thousands of dollars that we had to pay out of pocket. So the money racks up quick. If we did not have major medical insurance, then we may not have been covered for that. So that's an important thing to have. Dental insurance is something that's typically pretty cheap, maybe $20, $30 a month a lot of times when you get it through your employer. And it's really great to have. Typically, they pay 100% of your 2 cleanings a year, which is really great to go get those cleanings. They'll also pay a percentage of most of your other necessary dental procedures, getting a cavity filled or a crown. Those things can still be very expensive, but dental insurance will help pay for some of that. Vision care insurance, very important if you have any vision problems, if you wear glasses, hopefully you already have that. And that's usually very cheap also. And then something I hope we never have to use, but especially as you get older, this would be something important to look into: long-term care insurance. So this is for covering if you need care around the clock. So maybe for elderly people or for people that get into a really bad injury or some kind of sudden illness, you may need around the clock care, and this can help to pay for that. So some important terms, we already talked about deductibles when we talked about home and auto insurance, but just to cover it again, it is a set amount that the policyholder, that's you, has to pay towards the medical expenses before the insurance company pays their benefits. So it may be, usually when we talk about insurance, a deductible on a car, it's usually around $500. So you'd have to pay $500 before the insurance company paid anything. When it comes to yourself, you could easily have a deductible of $5,000. That's usually a high deductible plan, meaning you have to pay $5,000 of expenses before the insurance company will pay anything. Of course, that means that your monthly premiums will be much lower than somebody who has a deductible of $1,000. So it's all things you have to weigh and determine how much do you think you're going to be using that insurance. We're going to look at a problem in a second that is going to use deductible, and it's also going to use co-insurance. So co-insurance is a percentage of medical expense that the policyholder has to pay in addition to the deductible. So a lot of times the insurance company will say, we will pay 80% of any visit for a specialist. Maybe you broke your arm, and they say after your deductible, we will then pay 80% and you're responsible for the other 20%. Or it could vary a lot. It could be 70% the insurance company will pay, you'll pay 30. Of course, if it's that case, then you would have lower premiums. That's your co-insurance. A stop loss, that's a provision that requires the policyholder to pay all costs up to a certain amount. Then the insurance company pays 100% of the remaining expenses. So this is a situation where you do just have this insurance in order to cover major things. So let's say your stop loss number is $10,000. You have to have some major surgery that costs $50,000. You would have to pay $10,000 out of pocket, and then the insurance company would pay the other $40,000. That's really important to at least have some of this major medical like that has even the stop loss, because that way you are not walking around with no insurance. You get in an accident. I have a friend who got in an accident a few weeks ago and had no insurance and ended up being in the hospital for weeks and weeks and had multiple surgeries. And if they even had the major medical that had the stop loss on it, then it would have prevented them from having to pay hundreds of thousands of dollars for that accident. So it's important to have some kind of major medical like this. And then there's co-payment. This is a flat fee that you would pay every time you receive a covered service. This would also be listed out whenever you are making your decision on which insurance to choose. So let's say you are going in to have blood work done. There's going to be a fee that you pay that day. Maybe you have a $50 copay, maybe a $30 copay. So every time you go to the doctor, pretty much you're at least going to pay that amount. So you're going to pay that while you're there. Insurance may cover the rest, or you may get a bill for the rest later. But typically well visits, one well visit a year for each person covered is going to be covered 100% because they want to encourage you to go to the doctor and get those regular checkups before things go wrong and it ends up being a really expensive thing. They want to make sure that you are catching things early on and that you're staying healthy. All right, so our example here for deductibles and co-insurance, Ariana's policy includes an $800 deductible, so she has to pay $800 before the insurance company will pay anything. Then she has a co-insurance provision requiring her to pay 20% of all bills. If her bill total is $3,800, then the insurance company will first exclude the $800 because they know that Ariana's got to pay the $800. Then they will pay 80% of that remaining $3,000. So they're going to pay $2,400. Ariana will pay $1,400. Let's look at that broken out a little bit more. So we have $3,800 bill. Ariana has to pay an $800 deductible right off the top. So if we take $3,000 minus $800, or $3,800 minus the $800 deductible, at this point we have $3,000 left over. Ariana has to pay 20% of all of the stuff left over after the deductible. So 20% times the $3,000. So this is how we're calculating it to figure out how much Ariana is required to pay. We took the $3,800 minus the $800 deductible to give us our $3,000 times 0.2 times 20%. So that first little section there is just going to give us the 20% of $3,000. Then we have to add on the $800 deductible that she paid. So that would give us a total of $1,400 that Ariana paid, leaving the $2,400 up to the insurance company. Okay, so most of what we talked about so far are private healthcare plans. We're going to continue to talk about those, and then we'll touch on governmental healthcare plans. So private insurance companies, there are hundreds of different ones. You hear about the different healthcare plans, whether it's through your company or commercials, but there are hundreds of different private healthcare plans where you're going to see that when you see the group healthcare plans that your employers offer. Those are private. Hospital and medical services, you've probably heard of Blue Cross and Blue Shield of South Carolina. There's one in each state. The Blue Cross portion gives all the hospital care benefits, and Blue Shield provides benefits for surgical and medical services. Then we have this thing called a HMO. So it's Health Maintenance Organizations. So this is health insurance plan that directly employs or contracts with selected physicians and other medical professionals to provide health care services in exchange for a fixed prepaid monthly premium. So in other words, an HMO, the insurance company says anybody that uses us has to use these specific doctors, these specific physicians for any of their medical needs if they want to be covered. So you're going to pay a monthly premium for that, but it would be a lower premium as the policyholder because you have to choose from their selected physicians. A PPO, Preferred Providers Organizations, is a variation of that same thing, the HMO, except there are higher premiums because They are not as strict when it comes to which doctors you can use. And a lot of times they don't even have a deductible that you have to pay. So it's the same idea. You're getting that group health insurance, but you have more options for which doctors you can use. And a lot of times no deductible. So it's going to cost you a little bit more. All right, we have a few healthcare accounts that are really awesome. So this is important to listen to, something that you want to pay attention to whether or not this is something your employer is offering. So first we have the flexible spending accounts. We call them FSAs. So this allows you or your employer to contribute pre-tax dollars to an account that your employer manages. And you can use the money that you put in that account for any healthcare expenses. The only problem with it is at the end of the year, anything you have left over, you lose. It's forfeited. So you have a big advantage here that any money that's put in this FSA is going to be tax-free. So you can put it in there straight from your paycheck. And then you can use it when you go pay your co-payment, when you go to the doctor for whatever reason, when you go get your prescriptions, you can use it. Even on some medicine, you can use this. So that's really awesome. You're getting money that you can spend pre-tax. That's great. But like I said, the only problem is you lose any money you didn't spend at the end of the year. That's not so great. So my biggest suggestion with this is if your company offers this FSA, sometimes they will contribute some money to it, then definitely take advantage of using that money. And maybe put a little of your own in, but make sure you are using it all before the end of the year. Otherwise, you're going to lose money instead of making money from it being pre-tax. A health reimbursement account, an HRA, is something that some companies offer with high deductible policies. They're offering it as an incentive, saying, hey, we'll have to pay less on our path if you choose the high deductible plan because those are cheaper each month. So if you would do that, if you would choose that high deductible plan, we will give you some money in this account. This account is fully funded by your employer. And that money does carry over from year to year. So they are giving you money. Hey, you choose the high deductible, but we are going to give you, it could be $500, $1,000 a year. And you can use that on any medical expenses you have. And that you won't lose each year. However, you would lose it if you change jobs. So it's also an incentive from the company to stay at that facility, at that job. All right, this one's my favorite, Health Savings Account, HSA. So this is the best of both worlds. You can contribute money tax-free. Your company could also. And it is going to be for any medical expenses that you have to pay for. But you do not lose the money that you don't use at the end of the year. And you can change jobs all you want and you're not going to lose the money. Some people actually use this HSA as a retirement savings because as you get older, you typically are going to have more medical expenses. So this is a cool way that over the years, you can put money in this tax-free. And then if you don't use it at the time, it keeps rolling over and building on itself. And you've got all this money sitting there in this account that you can use for your medication, for your doctor's visits, whatever it may be. So it's pretty awesome. All right, so we've talked about private healthcare. There's also some government healthcare programs. You've probably heard of Medicare. That is federally funded. It's partially funded by Social Security. So when you see Social Security come out of your check, part of that is going to Medicare. This is mainly for people over 65 and people with disabilities. Now, Medicare is not comprehensive, meaning just like your Social Security check that you'd get at a certain age, Medicare is not intended to fully take over any insurance. It's not going to fulfill all of your medical needs necessarily. You may have to fill in the gaps there. So we have something called Medigap. So if you have Medicare and you need some additional coverage because Medicare doesn't give you everything you need, then you can get more coverage. You can buy more coverage through Medigap. Then we also have Medicaid. This is for certain low-income individuals and families, also government funded by the state or federal funds. So ultimately, taxes are paying for this. This Medicaid, however, is comprehensive. You do not need to get Medigap. You don't need to add things to it, most likely. This is supposed to be a complete substitute for insurance. All right, and then also I want to talk a little bit about disability income insurance. So disability income insurance is when you get hurt not on the job, not work related, or maybe you're pregnant or you have an illness, anything that causes you to be out of work that was not related to work. Now, if you got hurt at work, you would use workers' comp. The company pays to have workers' comp so that your medical expenses could be covered and you could be paid a portion of your salary while you were out of work. But this is for something not pertaining to work. So you're going to be out of work for some period of time. A lot of companies will give you some disability income insurance, but you need to determine, is it enough? Do I need to get more? And that's another benefit that you can ask your company if they offer. And disability income insurance does not typically kick in right away. It may take a few weeks, maybe even a couple months before disability income insurance, before you're going to start getting that income. So you need to still have that emergency fund. This is not a replacement for an emergency fund. Oh, if I were to get hurt, I would get that disability income right away. It would pay most of my bills. I don't need an emergency fund. No, you usually are going to have to wait a while to get that. Trust me, I have a friend who ended up having to have spinal surgery, and it took her months before she was able to get the disability income. It was great that she had an emergency fund. And with disability income insurance, if you're wondering how much to get, you typically want to get 70 to 80% of your take-home income. So this is a replacement or a portion of your income. So if you are out of work, you still have money to pay your bills. All right, last slide here. We've talked about how expensive it is to incur any medical expenses and how expensive it is to have insurance. And even if you have the Affordable Care Act, which you can read a lot about in the book, I'm not going into detail about that in this lecture right now, but there's lots of details in the book. Most of it's just listed out, so you can look at that. But all of those things are very expensive. So here's some ways to consider saving. Well, one, we've already talked about. If you have an FSA offered to you, consider contributing to that, but not more than what you think you'll spend in a year. Consider getting that high deductible health plan with an HSA, and that way you can save money on your premiums and you can set aside some money into your HSA to spend on your medical bills or your prescriptions, whatever it may be. I always say buy generic, whether we're talking about medicines, we're talking about foods, whatever it may be, even we're talking about clothes. Generic is a lot of times, especially in medicine, just as good as the name brand. So that's a great way to save money. Ask a doctor if a follow-up appointment is necessary. Your doctor may say, okay, we're going to go ahead and schedule you for a follow-up in 6 weeks. Well, that is a way for the doctor to make more money. But is it necessary for you to have that follow-up? My daughter broke her arm years ago, and they initially wanted a follow-up visit with her, and I said, well, are you at all concerned about it not healing properly? They said, no, it's going to be completely fine. I said, well, we have a high deductible, and I don't want to come in here and spend more money because of a follow-up. So they said, that's fine. You really don't need to come back. So they're not going to be upset with you, hopefully. So consider asking if you need to do that follow-up. Use teledocs. This has definitely become way more popular with 2020 and coronavirus, but teledoc is often something you get with your actual doctor, or you can even get an app. Some insurance companies will even pay for this. This is where you get to FaceTime with a doctor, and they can a lot of times prescribe you something just by over the phone or FaceTiming. And if you are doing a video, you can show them if you have a rash or if you have whatever it may be. They can see how terrible you look. I don't know. But it's a great way to save money. Typically, these visits are way, way cheaper than going in person. And you don't have to worry about giving other people your germs or them giving you their germs. So I strongly suggest teledocs. My daughters and I have used that a lot this year for just minor things. Review your medical bills. You can see in this slide, I made a mistake. I put HAS on the second bullet point. Well, guess what? We all make mistakes, including the people that create the medical bills. Make sure that they didn't charge you for something they weren't supposed to. That's important. Appeal unfair decisions. You know, if your insurance company says, "Oh, we're not paying for that because blah blah blah," or the medical service, the hospital, doctor's office, whatever it is, says, "Oh, we're charging you this, blah blah blah." If you think that is truly unfair, then fight for it. You're the only person that is truly going to advocate for your own money, and that is your right to do that. And negotiate. I'm telling you, we have saved hundreds and hundreds of dollars by me negotiating with bills. When my husband had his kidney stone and we got the bill for over $3,000 after insurance paid their part, I called and said, if I pay this in full right now, what kind of discount will you give me? They immediately gave me 25% off, just right there, without even hesitation. When my daughter broke her arm, they told me it was going to be $500. I had a high deductible, so I was going to have to pay all that out of pocket. I said, can you make it any less? I literally just asked one simple sentence. Could you make this any less expensive? They changed it to $175, from $500 to $175 in 2 minutes from me just asking that question. And they said, well, actually, that $500 includes a cast, a follow-up appointment, this, that, all these things that you're not even getting. And I was going to be paying for that because I was just going to blindly do it. But by me asking, they were able to drop it so quickly. So please, again, be your own advocate. It really will save you tons of money. And staying healthy is a great way to save money on your health care and, of course, to live a better life. But the healthier you are, the less you're going to have to go to the doctor, the less prescription medicine you're going to have to take. And also, you may have lower insurance because you don't have so many claims. So these are all great tips. Please let me know if you have any questions, and I hope you will join me for the next lecture.